Imagine waking up, making your morning coffee, and seeing headlines screaming that the Australian government just killed wealth building forever. The massive changes to the capital gains tax have investors officially panicking. The golden era of the legendary 50% capital gains tax discount is coming to a violent end. For decades, this loophole was the absolute cornerstone of how everyday Aussies built wealth. Now, the rules are fundamentally shifting. The ultimate question is spreading like wildfire across the country. Is it still actually worth investing in shares in 2026? Or is the ASX completely dead, and should you just hoard your cash under a mattress? Today, we are cutting straight through the media hysteria and political noise. I am going to break down exactly how these new capital gains tax rules work, and why you might be panicking over absolutely nothing. First, let's look at the raw facts. The government announced that the 50% CGT discount for individuals and trusts is being abolished and replaced with a system reverting back to cost-based indexation. They are also introducing a brand new 30% minimum tax rate on your real capital gains. It sounds absolutely terrifying on paper, but before you panic sell your portfolio, you need to understand the critical grandfathering rules. If you are investing right now in 2026, any capital gains your portfolio builds up before the upcoming cutoff will still magically qualify for the old 50% discount. They are legally locking in the old rules for current growth. This means sitting in cash today out of fear is the absolute worst financial decision you could make. You have a shrinking window of time right now to aggressively accumulate assets and lock in that legacy tax treatment. Now, let's explain how the new indexation system works once it kicks in. Indexation simply means the tax office adjusts the original purchase price of your shares upward to perfectly match the exact rate of inflation over time. If you buy $10,000 worth of shares today, and inflation runs hot, your cost base slowly rises. When you finally sell, you are not taxed on that inflation-driven fake growth, only on your real, above-inflation profit. And what about that 30% minimum tax floor? The government specifically designed this to stop ultra-wealthy Aussies from hoarding millions in shares and selling them only when their personal income drops to zero. But here is the reality check the media is ignoring. If you are an average worker earning over $45,000 a year, your marginal tax rate is already sitting at 30% or higher anyway. For the vast majority of everyday, working Australians building wealth on the side, that new 30% floor changes absolutely nothing about your daily tax reality. You are already paying that exact rate on capital gains. Do not let a tax change explicitly designed to target multimillionaires stop you from starting your own wealth journey today. The absolute worst thing you can do is let the fear of tax completely paralyze you. There is also a massive reason why shares are about to become incredibly popular. The government just violently attacked property investors by limiting negative gearing strictly to brand new builds. Established property is no longer a tax haven. Compared to property, investing in the share market is still the ultimate wealth builder. You don't need a massive $200,000 deposit to buy an ETF. You can literally start building a financial empire today with just $500. Shares are completely liquid and completely hassle-free. You don't have to deal with aggressive real estate agents, brutal stamp duty taxes, horrible tenants, or waking up to fix a broken hot water system on a Sunday morning. And let's talk about the undisputed king of Australian share investing, the massive secret weapon that the government completely left untouched in this budget, the legendary franking credit system. Dividend imputation perfectly survived the changes. When massive Australian companies pay their corporate tax, the government still hands that tax straight back to you as a fully refundable, hard cash credit. This unique system means an incredibly boring 4% dividend yield on the ASX magically grosses up to roughly 6% in real life. It remains the ultimate legal tax shield for everyday investors generating passive income. Because the new CGT rules only attack the capital growth when you actually sell an asset, dividend investors are laughing. If you build a portfolio to generate passive cash flow, you never have to sell a single share. And if you never actually sell your shares, you never trigger a capital gains tax event in the first place. The new rules are completely irrelevant if your strategy is simply to buy, hold, and collect massive dividends forever. The days of frantically day trading stocks to flip a quick profit are completely dead. The new tax system heavily punishes short-term gamblers and beautifully rewards long-term, disciplined holders who build true generational wealth. If you aggressively buy high-quality ASX index funds and hold them for 3 decades, the sheer velocity of your compounding wealth will absolutely crush any new tax rules. Time does the incredibly heavy lifting for you. Let's also talk about the ultimate tax loophole that remains wide open for you right now, your superannuation. The government specifically excluded super funds from these brutal new capital gains tax changes. If you are genuinely terrified of the new tax laws, your strategy is simple. Aggressively pump extra cash into your super through salary sacrifice. Inside that protected environment, your capital gains are taxed at a maximum of just 15%. And once you hit preservation age and transition your super into the pension phase, your tax rate on those massive capital gains instantly drops to absolute zero. It is the perfect legal haven for long-term wealth. To insulate yourself from short-term volatility, rely heavily on diversified ETFs. Massive exchange-traded funds like VAS automatically balance out the winners and losers, automatically smoothing out your returns and optimizing your overall growth. Every single time the government changes the tax code, average people panic and freeze, while the wealthy immediately adapt their strategy and continue getting richer. Blind fear is the absolute enemy of financial freedom. So, is it worth investing in shares in 2026? The answer is a massive, undeniable yes. You have a choice. Complain about the government changing the rules, or learn the new rules and aggressively play the game to win. Take advantage of the grandfathering window, maximize your super loopholes, hunt down those beautiful franking credits, and stop letting terrifying headlines dictate your future. Smash that like button, subscribe, and I'll see you next time.